Most people spend their entire working lives following a script they never consciously chose. Go to school, get good grades, find a stable job, work hard, get promoted, save a little money, retire somewhere around 65 if you're lucky, and hope the pension and savings are enough to last. This script is so widely accepted, so deeply embedded in how families talk about the future and how schools measure success, that questioning it feels almost irresponsible. And yet, if you look honestly at where this script actually leads for the majority of people who follow it faithfully, the results are genuinely troubling. Most people who spend 40 years climbing the employment ladder retire with far less financial security than they assumed the script would deliver. Most people who save diligently their whole lives find that inflation and taxes have quietly eroded the real value of those savings year after year. And most people who were told that a good education was the reliable path to financial freedom end up financially dependent on a paycheck, a pension, or both, until the very end. In 1997, a man who had grown up watching two very different approaches to money, one cautious and conventional, one unconventional and deliberately educational, sat down and wrote a book about what he'd learned from the contrast. That book has now sold over 40 million copies, spent years on the bestseller lists of every major publication, and is consistently cited by people across every income level as the book that first made them think differently about money. Its name, by now almost universally recognizable, is Rich Dad, Poor Dad. Its author is Robert Kiyosaki, and its central argument, stated plainly, is that the most important things you need to know about money are almost exactly the opposite of what school taught you, and almost exactly the opposite of what most well-intentioned parents pass on to their children. In this video, I'm going to give you the most complete, honest, and practically useful breakdown of this book I possibly can. We'll cover the core philosophy, the specific financial concepts the book introduces that most people have genuinely never been taught, the habits of mind that separate people who build wealth from people who stay stuck on the treadmill, the honest criticisms and genuine limitations of this book that deserve direct acknowledgement, and exactly what you can take from this material and start applying, regardless of where you're starting from financially. Stick with me to the end, because the final section is where we separate the genuinely actionable from the parts that require more careful thinking. Let's start with the story the book is built around, because it's the frame through which every concept is introduced, and understanding it makes the rest of the book click into place. Robert Kiyosaki grew up in Hawaii with a father he later called his poor dad, a highly educated man, a PhD holder who worked hard his entire life in public education, believed deeply in the value of academic credentials and job security, and consistently struggled financially despite his income. His poor dad's advice was the conventional script: study hard, get a secure job, work your way up, be careful with money, save for retirement. This father was not a failure by ordinary measures. He was respected, educated, and professionally accomplished. He simply never became financially free. At the same time, young Robert was spending significant time with the father of his best friend, a man he called his rich dad. This man had dropped out of school at 13, built multiple businesses from the ground up, and by the time Robert encountered him, was genuinely wealthy in a way his own father never was. His rich dad's financial education looked nothing like school. Instead of textbook lessons, it was practical, uncomfortable, and often deliberately confusing in ways designed to force Robert to think rather than simply absorb and repeat. And the philosophy it produced was radically different from anything Robert heard at home or in class. The contrast between these two men is the engine of the entire book, not because one was smart and one was foolish, but because they operated from fundamentally different mental models about how money works, what creates wealth, and what financial security actually means. And Kiyosaki's argument is that the mental model most people inherit from their educated, hardworking, conventional parents is exactly the model that keeps most people on the financial treadmill for their entire working lives. Now let's get into the specific concepts, because this is where the book does its most valuable work. Several of the ideas it introduces are genuinely simple, but have real explanatory power for why most people stay financially stuck despite working hard and following the conventional advice they were given. The first and arguably most important concept is the distinction between assets and liabilities, which the book defines very differently from how accountants and financial textbooks define them. In the book's framework, an asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. That's it. That's the entire definition. And by that definition, many things that most people call assets, most crucially, the house they live in, are actually liabilities. This is probably the most controversial and most misunderstood idea in the entire book, so it's worth spending real time on it. When most middle-class families think about building wealth, their primary strategy is buying a home. They believe that their house is their most important asset, and that the equity they build in it over time is the foundation of their financial security. Rich Dad, Poor Dad challenges this belief directly. A house you live in, the book argues, is not an asset in any meaningful financial sense. It takes money out of your pocket every month in the form of mortgage payments, property taxes, maintenance, insurance, and utilities. It does not generate income. It does not put money in your pocket. Therefore, by the book's definition, it is a liability, even if it appreciates in value over time, because that appreciation is largely theoretical until you sell. And in the meantime, it is actively consuming your cash flow month after month. An asset in the book's framework is something that generates income without requiring your active labor. A rental property that produces monthly rent, a stock that pays dividends, a business that runs without requiring your daily presence, a royalty from a piece of intellectual property. These things put money in your pocket while you sleep, and it is the accumulation of these genuine assets, rather than the accumulation of things that look like assets but are actually consuming cash, that builds real, lasting wealth. The practical implication of this distinction is significant. Most middle-class families spend their entire careers buying liabilities while believing they're building assets. They buy a bigger house as they earn more, which increases their mortgage, taxes, and maintenance. They buy nicer cars, which depreciate immediately. They accumulate furniture, appliances, and consumer goods on credit, paying interest month after month. And they do all of this in the sincere belief that they are doing the responsible, financially prudent thing, because this is what success is supposed to look like. And nobody ever clearly taught them the difference between something that generates money and something that consumes it. The second major concept is what the book calls the rat race, a term so memorable that it has become part of the cultural vocabulary around money, even for people who have never read this book. The rat race describes the financial trap that most working people find themselves in, not because they're lazy or foolish, but because of the structure of how they relate to money. The cycle works like this. You get a job and start earning money. The money feels good and you want more of it, so you spend it, usually on lifestyle upgrades that feel like rewards for your hard work. As your spending increases, you need more income to cover it, so you work harder, take on more responsibility, seek promotions, and earn more. But as your income increases, so do your taxes, and so does your spending, and so do your liabilities, because more income tends to produce more desire for the lifestyle markers that income is supposed to enable. And so you run faster and faster, working harder and harder, for more and more money, while getting further and further from the financial freedom you thought the income was supposed to deliver. The key mechanic that keeps the rat race running is the emotion-driven response to money that most people were never taught to recognize. When most people earn more, they feel it as permission to spend more. When they see something they want, they reach for credit to get it immediately rather than building the asset base that would eventually allow them to buy it without stress. And when they feel the financial pressure of the resulting debt and obligations, their instinctive response is to work harder and earn more, which only feeds more spending, which only feeds more pressure, in a cycle that most people never consciously examine, let alone interrupt. The third major concept is financial intelligence, which the book treats as a form of literacy that schools don't teach and that most families don't transmit, because most families don't have it themselves. Financial intelligence in the book's framework involves understanding four basic things: accounting, which is the ability to read and understand financial statements; investing, which is the science of making money make money; understanding markets, which means having a sense of how supply and demand work and how to identify opportunities; and understanding the law, including how tax and corporate structures work, and how wealthy people legally use these structures to protect and grow their wealth in ways most employees never learn about. The book doesn't try to make you an expert in all of these. Its goal is to make you aware that they exist, that they're learnable, and that most people who struggle financially do so not because they lack intelligence or effort, but because they lack this specific form of literacy that nobody ever taught them. And the book argues that cultivating financial intelligence, even basic literacy in these four areas, is more valuable than any salary increase you might earn, because it changes the decisions you make with whatever money you have, rather than just giving you more money to make the same poor decisions with. The fourth major concept is the difference between working for money and having money work for you. This is the central aspiration the book points toward, and it's the thing that distinguishes the financially free from the financially dependent. Most people, the book observes, have a linear relationship with income. They trade their time for money, 1 hour producing 1 unit of pay, and when they stop trading time, the money stops coming. This works fine as long as the trade is sustainable, but it is by definition not scalable and not passive, which means it can never produce the kind of wealth that doesn't depend on your continued labor. Having money work for you means building or acquiring assets that generate income independently of your time, so that your income continues and grows even when you're not actively working. This is not a revolutionary idea, but the book's contribution is in making it concrete and personal, in arguing that this isn't something only rich people can aspire to, and in pointing out the specific mental and behavioral patterns that keep ordinary people from ever getting started on this path, even when they genuinely want to. Now let's talk about the 6 specific lessons the book builds its structure around, because these are the practical framework through which all of the bigger ideas get grounded. The first lesson is that the rich don't work for money. This is counterintuitive and requires careful unpacking, because it sounds like an argument that rich people don't work, which isn't what it means. What it means is that the rich primarily use their time and energy to build and acquire things that generate income, rather than primarily using their time and energy to perform labor in exchange for a paycheck. This is a fundamentally different orientation toward work, time, and money, and it produces fundamentally different outcomes over time, because it compounds rather than simply adding. The emotional dimension the book focuses on here is the role of fear and desire in financial decisions. Most people, when they feel financial pressure, respond by working harder to earn more money, which is the fear response. And when they feel financial relief after a good period, they respond by spending more on things they want, which is the desire response. Both of these reactions keep the person locked in the earn-spend cycle rather than ever building something that generates income independently. Rich Dad Poor Dad argues that the financially literate person learns to observe these fear and desire impulses without immediately acting on them, creating enough space between the emotion and the decision to make a more considered choice. The second lesson is the importance of financial literacy. The book uses a simple visual tool to make this concrete: a cash flow diagram. For most middle-class people, money comes in as income from a job and immediately flows out as expenses, including the payments on the liabilities they've accumulated. There is no column for assets that generate income and no column for passive income, because these things don't yet exist in their financial life. The rich person's cash flow diagram looks different. It has an asset column generating income, and expenses are paid from that passive income rather than from active labor. The goal of financial literacy, the book argues, is to understand this diagram clearly enough to start, deliberately and consistently, building the asset column rather than simply maximizing the income column and hoping the expenses somehow stay lower. The third lesson concerns minding your own business. This is one of the most misunderstood phrases in the book, because it sounds like advice to be self-employed or run your own company, which isn't quite what it means. What it means is keeping your attention and financial focus on building your own asset column rather than spending your career making other people's asset columns larger. The book's point is that most people spend their working lives making their employer rich, and then going home to spend their paycheck in ways that make the bank and the retailer rich, while their own asset column sits empty, year after year. Minding your own business means that regardless of whether you have a job, you are simultaneously and deliberately building assets that belong to you, not your employer, outside of your working hours, starting as small as necessary and building consistently over time. The fourth lesson concerns taxes and corporations, and this is where the book gets most directly into the structural differences in how wealthy people and ordinary employees relate to the tax system. The book makes the observation, which is legally accurate, that a corporation pays taxes after expenses, while an employee pays taxes before expenses. An employee earns a salary, the government takes its portion off the top, and whatever remains is what the employee has to live on and save. A corporation, by contrast, earns revenue, deducts legitimate business expenses, and pays taxes only on the profit that remains. Wealthy people who understand this use legal corporate structures to access a wider range of tax-advantage strategies than employees can, and this structural advantage compounds significantly over long periods of time. The book is careful, and this is worth noting, to say that it is not recommending anything illegal. It is recommending that ordinary people become more financially educated about the legal structures that exist and that wealthy people routinely use, rather than remaining ignorant of them by default, which is what most people's conventional financial education leads to. The fifth lesson is about the rich inventing money, which is the book's way of saying that financial opportunities are often created rather than simply found, and that the ability to identify and structure a deal is itself a learnable form of financial intelligence. The book gives examples of real estate deals where the key insight wasn't finding cheap property, but structuring the transaction in a way that generated positive cash flow from the first month, and where the actual return came from understanding the numbers rather than from simply owning real estate. The sixth lesson is about working to learn rather than working to earn. This is aimed specifically at young people who are choosing careers primarily based on how much they pay, rather than on what skills and knowledge they develop. Rich Dad's advice to Robert was to take jobs that would teach him sales, marketing, accounting, and management, even if those jobs paid less, because those skills were transferable assets he would carry for the rest of his life and use to build real wealth. A high-paying job that doesn't teach you anything transferable makes you dependent on that specific job. A lower-paying job that builds genuine, portable skills makes you eventually capable of creating income in many different ways. Now let's get into the mindset principles the book spends significant time on, because the practical tools only work if the underlying mental model supports them. The single most important mindset shift in the entire book is the difference between saying, "I can't afford this," and asking, "How can I afford this?" These two responses to the same financial situation produce completely different cognitive and behavioral results. "I can't afford this" is a statement that closes the mind. It's final, passive, and produces no further thinking. "How can I afford this?" is a question that opens the mind and forces it to search for creative solutions. The book argues that Poor Dad used the closed statement habitually, never creating the mental pressure to think of alternatives. Rich Dad used the open question deliberately, training his mind to search for options rather than accepting limitations at face value. This sounds like positive thinking, and the book is sometimes dismissed on those grounds, but the mechanism is actually more specific than that. The human brain is a pattern completion engine. Ask it a question and it will work on generating an answer, often well outside your conscious awareness. State a conclusion, and it accepts the conclusion and stops working on the problem. The habit of converting financial conclusions into financial questions is therefore a real, practical tool for expanding the range of solutions your mind will consider, not a motivational platitude. The second mindset principle is what the book calls the importance of boldness over fear. Most people, when they encounter a financial opportunity they don't fully understand, let their fear of making a mistake stop them from pursuing it at all. They wait until they feel ready, until they know enough, until the timing is exactly right, until the risk feels manageable. And because none of these conditions ever fully arrive, they never start. Rich Dad's advice was essentially the inverse. You learn by doing, and waiting to feel ready before beginning is a reliable strategy for never beginning at all. This doesn't mean taking reckless risks with money you can't afford to lose. The book is clear about the importance of education and due diligence. What it means is that a reasonable level of risk, undertaken from a foundation of basic financial understanding, is necessary for any meaningful return, and that the people who wait for certainty before investing are effectively choosing the near certainty of very small returns over the possibility of significant ones. The third mindset principle concerns overcoming cynicism and laziness. The book makes the observation that cynicism is often a form of protected pessimism. By deciding in advance that something is too risky, too complex, or too unlikely to work for someone like me, you protect yourself from the disappointment of trying and failing, but you also guarantee the outcome you are trying to avoid. Laziness, in the book's framework, is often not about physical inaction, but about mental avoidance. The busy, successful person who says they're too busy to think about their finances is displaying a form of laziness in the specific domain of financial education that they'd never accept in their professional domain. The book's response to both of these is essentially the same. What would happen to your financial life if this actually worked? Following that question honestly, rather than dismissing it with a cynical answer, is the practice the book recommends. Now let's talk about what the book actually recommends doing, because philosophy without action is just an interesting conversation, and this book is ultimately meant to change behavior, not just thinking. The first practical recommendation is to pay yourself first. This principle, which has been around in personal finance literature for a long time, means that before you pay your bills, before you pay your taxes if legally possible, before you allocate any money to expenses, you allocate a portion to building your asset column. Most people pay everyone else first and save whatever is left over, which is almost always nothing. The financially literate person makes saving and investing non-negotiable, and then deals with the pressure of reduced cash flow by finding ways to increase income or reduce expenses, rather than by skipping the asset building step entirely. The psychological reason this works is the same as the minimum standard we discussed in the Imperfectionism book. By making the commitment non-negotiable first, you create pressure that forces you to find solutions. By making it optional and doing it with whatever's left over, you ensure it never happens, because there is never anything left over when spending is the default. The second practical recommendation is to become financially educated. The book is specific about what this means. Reading financial statements, understanding basic accounting concepts, learning how investment instruments work, studying how successful investors think, and building enough knowledge about legal and tax structures to have an intelligent conversation with the lawyers and accountants who can then help you implement them. The book doesn't recommend becoming a professional in these areas. It recommends becoming literate enough to stop being taken advantage of through ignorance, and to start recognizing opportunities that your current financial vocabulary doesn't even let you see. The third practical recommendation is to build or acquire assets before buying liabilities. Every time you get a raise, a bonus, or any kind of financial windfall, the conventional impulse is to upgrade your lifestyle, which means buying more liabilities. The financially intelligent move, the book argues, is to direct that additional income first toward building or acquiring something that generates income, and to use the income from that asset to fund lifestyle upgrades rather than funding them directly from labor income. This sequence, assets first then lifestyle, instead of lifestyle first, then hopping assets somehow appear, is the structural difference between how wealthy people and ordinary earners relate to increased income. The fourth practical recommendation is to find good mentors and advisors. The book is direct about the limits of the do-it-yourself approach in complex financial domains. Kiyosaki's rich dad had a team of financial, legal, and tax advisors, and he argues that paying skilled professionals for advice in these areas is one of the best investments you can make, because their expertise can save or generate far more than their fees. The key is working with advisors who are financially sophisticated themselves, who have the kind of financial results you're aiming for, rather than advisors who simply sell products or give generic, liability-avoiding advice. Let's now address the honest criticisms of this book, because they're significant and they deserve direct acknowledgement rather than being glossed over. The first and most serious criticism is that the book is long on philosophy and inspiration, and short on specific, actionable instructions. It tells you repeatedly that you need to build assets and acquire financial education, but it doesn't tell you with any precision how to do this for someone starting from zero with a limited income, significant debt, and no existing investment knowledge. A reader who finishes this book feeling inspired and convinced often finds themselves asking the very concrete question of what exactly they're supposed to do next, and the book doesn't answer that question very satisfyingly. The second major criticism is about accuracy and verification. The core narrative of the book, the two fathers and the specific lessons Rich Dad taught, has been questioned extensively over the years. Kiyosaki has given inconsistent accounts of whether Rich Dad was a real person or a composite, and some of the specific claims made in the book, particularly around real estate investing and certain tax strategies, have been criticized by financial professionals as oversimplified, sometimes inaccurate, and occasionally inapplicable in the actual regulatory environment most readers live in. The third criticism concerns the real estate focus. The book was written in the late 90s during a period of significant real estate appreciation, and its enthusiasm for real estate as the primary vehicle for building an asset column reflects that context. The strategies it describes around leveraged real estate investment carry real risks that the book sometimes underplays, and some readers who followed this advice, particularly in the period leading up to the 2008 financial crisis, experienced genuinely significant financial losses. The book's attitude toward debt and leverage, particularly using other people's money to buy income-generating properties, is more nuanced in practice than the book makes it sound. The fourth criticism is more philosophical. The book can be read as implying that financial success is primarily a function of mindset and financial education, which can slide toward a dismissal of structural barriers. Someone with significant student loan debt, limited income, no access to investment capital, and no social networks that include wealthy or financially sophisticated people faces genuinely different starting conditions than the book tends to acknowledge. And telling that person that their main problem is mindset and financial literacy, while not entirely wrong, is also not entirely sufficient. These are real criticisms, and they should inform how you engage with this material. The best approach is to extract the genuine philosophical and conceptual value the book offers, which is real and significant, while being appropriately skeptical of the specific tactical claims, and appropriately humble about the complexity of translating general principles into specific financial decisions for your particular situation. Let's look at what remains genuinely valuable after holding those criticisms honestly. The core conceptual contribution, the distinction between assets and liabilities defined in terms of cash flow, is genuinely useful and genuinely not what most people were taught. Understanding that a house you live in takes money out of your pocket, while a house someone else rents produces money into your pocket, is not a complex idea, but it has real consequences for how you think about financial decisions. And most people genuinely haven't thought about it this way before reading this book. The observation about the rat race, the way that increased income tends to produce increased spending rather than increased wealth unless you deliberately intervene in that pattern, is empirically well supported and represents a real structural challenge that most conventional financial advice doesn't address directly. The book's framing of this challenge is memorable and specific in ways that more academic treatments often aren't. The emphasis on financial education as a genuine skill that can be developed, rather than a talent some people have and others don't, is important and underemphasized in most school curricula. The specific identification of accounting, investing markets, and law as the relevant domains of this education gives people a starting point for what to actually study that is more useful than the generic advice to learn about money. And the fundamental reorientation from thinking about income to thinking about cash flow, from asking how much do I earn to asking how much does my money earn, is a shift that, once made, tends to produce permanently different financial decisions, even for people who are skeptical of some of the book's more specific claims. Let's look at how these ideas play out for people at different financial starting points, because the book is sometimes accused of being irrelevant for people who aren't already in a comfortable financial position, and that accusation is worth examining honestly. For someone with significant debt and limited income, the immediate practical value of this book isn't in its investment strategies. It's in the conceptual framework it provides for understanding why conventional financial advice, work hard, spend carefully, save a bit, isn't actually a path to financial freedom. And in the motivational case, it makes for prioritizing financial education over lifestyle spending, as the most valuable investment of limited time and money. The specific takeaway for this person might simply be, before you upgrade anything in your financial life, spend some of that money on books, courses, and advisors that build financial literacy, because the return on that investment is higher than almost anything else you can do from this starting point. For someone in a stable middle-class position with some disposable income and no immediate financial crisis, the book's most applicable insight is probably the asset before lifestyle principle. Take a portion of every income increase and route it deliberately towards something that generates income rather than something that consumes it. This doesn't require starting a business or becoming a real estate investor immediately. It might simply mean redirecting a portion of each paycheck into an index fund before spending the rest, and deliberately not upgrading your lifestyle in proportion to every salary increase until the asset column is genuinely working. For someone who is financially comfortable but has accumulated mostly lifestyle assets rather than income-generating ones, the book's most applicable insight is the cash flow clarity it provides. Looking honestly at what everything you own actually costs you per month versus what it actually earns you per month often reveals that the financial picture looks very different from how it feels, and that the gap between asset column and liability column is larger than assumed, and that this gap has real implications for how long the current financial position can be maintained without continued labor income. The pattern across all three of these starting points is the same. The book's greatest practical value is not in its specific investment recommendations, which are dated and context-dependent. It's in the framework it provides for thinking about money differently from the way most people were taught, and in the motivation it generates to take that different thinking seriously enough to actually do something with it. Let's run through some of the most commonly asked questions about this book before we move toward the final section. Question 1. Is the rich dad a real person? Kiyosaki has given inconsistent answers to this over the years, and the honest answer is that the specific identity has never been definitively confirmed. He has said that the character is based on a real mentor but may be partly composite. Whether the specific conversations described in the book happen exactly as described is less important than whether the financial philosophy attributed to Rich Dad is sound, which it is in broad terms, with the specific caveats we've discussed. Question 2. Is real estate really the best asset class to focus on? Not necessarily, and the book's emphasis on real estate reflects both Kiyosaki's personal background and the era in which it was written. Index funds, dividend-paying stocks, bonds, intellectual property, and online businesses are all legitimate asset classes that generate income without requiring your active labor. The book's framework of buying assets that generate cash flow is the valuable principle, not any specific implementation of it. Question 3. Is the advice in this book applicable outside the United States? Much of the specific advice around taxes, corporate structures, and real estate is U.S.-centric, and the regulatory and tax environment differs significantly in other countries. The philosophical framework, the concepts of assets versus liabilities, the rat race, cash flow, and financial education are broadly applicable. The specific tactical advice requires translation for different legal and financial environments. Question 4. Can this book be harmful? Yes, in specific ways. Readers who take the enthusiasm for leverage and real estate investment literally, without developing the specific financial knowledge to execute such strategies safely, have made serious financial mistakes. The book's confident, accessible tone can create a misleading sense that the strategies it describes are simpler and more universally applicable than they actually are. This is probably the most important caveat to carry into any engagement with this material. Question 5. What should I read after this book to go deeper? The book itself recommends developing accounting literacy, which means something like a basic accounting textbook. For investing, Kiyosaki has written additional books in the Rich Dad series, though these receive more mixed reviews than the original. For a more skeptical and academically grounded treatment of personal finance, books like The Psychology of Money by Morgan Housel, The Millionaire Next Door by Thomas Stanley, or A Random Walk Down Wall Street by Burton Malkiel provide complementary and sometimes corrective perspectives that round out the picture this book paints. Before we move to the final close, let's talk about the hidden cost of financial illiteracy, which is what this book is ultimately arguing against. Financial illiteracy isn't just the absence of knowledge about a technical subject. It has real, measurable consequences that compound over a lifetime. The person who doesn't understand the difference between an asset and a liability in terms of cash flow is likely to spend decades accumulating liabilities while believing they're building wealth. The person who doesn't understand how taxes work in different contexts is likely to overpay taxes their entire working life through ignorance of legal alternatives that their wealthier peers are routinely using. The person who doesn't understand how compound interest works in both directions, growing their savings and growing their debt, is likely to be surprised by both in ways that could have been anticipated and planned for. And perhaps most significantly, the person who believes that working harder and earning more is the reliable path to financial freedom is likely to find, somewhere in their 50s or 60s, that they have traded decades of their most productive years for a financial position that is more precarious than the script promised, and that they lack both the time and the knowledge to do much about it. This isn't meant to be frightening. It's meant to be clarifying, because the same mechanism that compounds financial mistakes also compounds financial learning. Every year you spend building genuine financial literacy, acquiring income-generating assets, and understanding how money actually works, rather than how school said it works, compounds into an increasingly stronger financial position. The gap between where you are and where you want to be financially is mostly a gap in knowledge, habits, and the specific decisions those knowledge and habits produce. And unlike gaps in talent or luck or circumstance, gaps in knowledge are genuinely, practically closable, starting with whatever you choose to read, ask, or do differently today. There's a pattern worth noticing when you talk to people across different financial positions about how they actually built what they have. The specific vehicles are different. One person built a rental portfolio, another built a business, another invested early and consistently in index funds, another developed a skill that generates royalty income. But the underlying structure is almost always the same. Somewhere early in their financial life, they grasped the distinction between having money work for them versus working for money, and they started, however slowly and however imperfectly, building the asset side of that equation rather than simply optimizing the income and spend cycle. The specific vehicle doesn't matter as much as starting to build something, anything, that generates income without requiring your constant presence. And the best time to start building it is before you feel ready, with less money than you'd like to have for the purpose, more ignorance than you'd prefer to be starting with, and in whatever imperfect, small, genuinely available form the opportunity currently presents itself. So let's close with something concrete. Before this week ends, do these 3 things. First, look honestly at everything you own and ask, for each item, whether it is putting money in your pocket or taking money out of your pocket. That honest audit, done for the first time by most people who do it, tends to be genuinely revelatory. Second, identify one thing in the next month you are planning to buy as a reward or lifestyle upgrade, and ask whether there's any way, even a partial or imperfect one, to redirect some or all of that money towards something that generates income instead. Third, spend 30 minutes reading or listening to something about basic accounting, basic investing, or basic tax strategy, topics you probably weren't taught in school, starting wherever feels most accessible from where you currently are. None of these three actions will make you rich by next Tuesday, but each of them begins the compound process of financial education and asset building that, given enough time and enough consistency, tends to produce outcomes dramatically different from the ones the conventional script delivers. Before you go, close your eyes for a moment and picture the version of you 20 years from now who started making these distinctions clearly today. Not the version who worked harder and harder in exchange for a paycheck that kept pace with an ever-expanding set of liabilities. The version who began, however imperfectly and however slowly, to build a column of things that earn money rather than consume it. Notice what is different about the financial choices available to that version of you. Notice what they no longer need to trade their time for. Notice what they're free to say yes or no to because their financial position has given them that particular kind of freedom. That version of you is not a fantasy. It's the compound result of a different set of decisions, starting from wherever you are right now. And the first different decision is simply understanding clearly, for the first time, the difference between something that takes money out of your pocket and something that puts money in. Thanks for watching all the way through. The first line of your own financial education starts with whatever question you ask or whatever page you open next. Let's go considerably deeper into some of the ideas we've touched on, because this book has layers that deserve more than a surface reading, and the difference between someone who reads it once and finds it interesting and someone who reads it seriously and lets it change how they think is usually in how deeply they sit with the core concepts rather than simply understanding them at a headline level. The concept of the income statement and balance sheet, which the book uses throughout, is worth unpacking more fully because most people have literally never been taught to read these documents in relation to their own personal finances, even though they are the most fundamental tools for understanding where you actually stand financially. An income statement tracks money flowing in and out over a period of time. For most people, the income column is essentially one item, their salary or wages. The expense column is everything that flows out: rent or mortgage, food, transportation, utilities, entertainment, loan payments, subscriptions. The problem most people have is that they only ever look at these two columns in isolation, and they manage their finances by the rough feeling of whether the income seems larger than the expenses, which it often barely is or isn't. A balance sheet, by contrast, captures a snapshot of what you own versus what you owe at a single moment in time. The asset column should list things that have value and ideally generate income. The liability column lists everything you owe: mortgages, car loans, student loans, credit card balances, and so on. The difference between the two is your net worth. Most people, if they honestly constructed these two documents for the first time, would discover something important. Their income statement would show that nearly all of their income is consumed by expenses, leaving very little to direct elsewhere. Their balance sheet would show that most items in their asset column are either depreciating consumer goods or the primary residence, which, as we discussed, costs money every month rather than generating it. And their liability column would often be surprisingly large relative to their assets, particularly when student loans, auto loans, and mortgages are added together honestly. The book argues that the financially educated person looks at these documents regularly, understands what they show, and uses them to make deliberate decisions rather than managing by vague feeling. And the specific direction those deliberate decisions should take, every time income increases, is toward growing the asset column rather than growing the expense column, which is what most people instinctively do when their income grows. There's also an important dimension of the book that concerns the difference between being an employee, a self-employed person, a business owner, and an investor, a framework sometimes called the cash flow quadrant, which Kiyosaki developed more fully in a later book of the same name but introduces here. An employee trades time for money and has very little control over either the income they receive or the taxes they pay on it. A self-employed person also trades time for money, but has more control over the work itself, while still being entirely dependent on their own labor for income. A business owner has built a system that generates income without requiring their constant presence, which is the beginning of real leverage. And an investor puts money to work in assets that generate returns, which is the purest form of money working for you rather than you working for money. The book's observation is that most people spend their entire careers moving between the first two quadrants, employee and self-employed, and never make the transition to the third and fourth, which is where financial freedom actually lives. And the barrier to making this transition is not primarily financial. It's conceptual. Most people don't understand that the transition is even possible, or that it requires a genuinely different relationship with money and time than the one school and conventional career culture prepare you for. Let's talk about one of the more subtle and underappreciated ideas in the entire book, which concerns the difference between being rich and being wealthy, and why this distinction matters more than it might initially seem. Being rich means having a high income. Being wealthy means having enough assets generating enough income that you could stop working tomorrow and your lifestyle would continue unchanged. These two conditions look similar from the outside because both involve money and a good lifestyle, but they're structurally very different. A rich person whose income stops faces an immediate crisis. A wealthy person whose income stops has barely noticed. Most people who aspire to financial success aspire to being rich, meaning to a high income from labor. But the book argues that this aspiration, even when achieved, doesn't actually deliver the thing most people want underneath it, which is freedom. Freedom from having to trade time for money, freedom to say no to things they don't want to do, freedom to choose how they spend their days based on interest and meaning rather than financial necessity. The financially intelligent aspiration is therefore not primarily a high income, but a growing gap between passive income and expenses, specifically the point at which passive income exceeds expenses, which is what genuine financial independence actually means. And the path to that point runs through the asset column, not through the income column, which is why the highest paid employee in the room is not necessarily closer to financial freedom than the person earning significantly less, but consistently directing a portion of that income toward income-generating assets. Let's also spend time on something the book introduces that most people miss on a first reading: the concept of financial IQ, which the book treats as genuinely learnable, and which it breaks into 4 specific skills. The first is accounting, meaning the ability to read numbers and understand what they're telling you about the financial health of a business or investment. You don't need to be an accountant. You need to be literate enough in financial statements to look at a deal and understand whether it makes money or loses it, and under what conditions. The second is investing, meaning understanding how different investment instruments work, what their risk and return profiles are, how leverage amplifies both gains and losses, and how to evaluate a specific investment opportunity rather than simply hoping the market goes up. The third is understanding markets, meaning having a basic grasp of supply and demand dynamics, of why prices move, of what creates opportunity in a given market at a given time, and of how to distinguish a genuine opportunity from a speculative gamble dressed in opportunities clothing. The fourth is the law, meaning understanding how the legal structures of corporations, trusts, and legal entities affect your tax position and your ability to protect assets you've built. This is the area where most ordinary people have the largest knowledge gap relative to wealthy people, and where financial education produces some of the largest returns, because the legal tools available to business owners and investors are genuinely different in kind, not just in degree, from what employees typically have access to. The book doesn't teach you any of these four skills directly. What it does is make clear that they exist, that they're learnable, and that not having them is costing you money in ways you can't fully see without them. This is perhaps its most practically important function, making you aware of the specific dimensions of what you don't know about money, so that you can begin directing your learning deliberately toward the areas where it will have the most financial impact. Let's also talk about fear and the book's specific treatment of it, because Kiyosaki is unusually direct about the emotional dimensions of financial decision-making in a way that most finance books are not. The book identifies several specific fears that keep people financially stuck. The fear of losing money, which keeps people in low-return safe investments, while inflation quietly erodes the real value of their savings. The fear of being judged, which keeps people from telling others about their financial goals, or from admitting that they're working on changing their financial situation, isolating them from potential mentors, partners, and advisors. The fear of being wrong, which keeps people from making decisions and taking positions, because being decisively wrong feels worse than making no decision at all, even though indecision has its own definite cost. And the fear of looking foolish, which keeps people from asking basic questions about financial topics they should have been taught but weren't, and from beginning the kind of visible learning curve that becoming financially educated requires. Kiyosaki's position on all of these fears is not to deny them or to suggest that they can be permanently eliminated. His position is that the cost of letting them run unchallenged is almost certainly higher than the cost of acting in spite of them, and that the people who build real financial independence do so not because they don't feel these fears, but because they've made the decision to move forward with education and action anyway, choosing the discomfort of deliberate risk over the slow, invisible, certain cost of permanent avoidance. One of the most important things the book says about fear, and one that doesn't get nearly enough attention in most summaries, is the observation that most people are not actually afraid of losing money. They are afraid of losing money and not knowing why. The person who loses money and understands exactly what happened, what they missed, what they would do differently, and how to avoid the same mistake next time, has not actually lost very much from a financial education perspective. The person who loses money through general bad luck or forces they couldn't have anticipated has lost something real, but not something that reflects a fundamental flaw in their approach. It's the person who loses money repeatedly without ever understanding why who is in the most troubling position, because they can't improve what they can't examine. This is why the book so consistently returns to financial education as the real foundation of financial security, not specific investments, not high income, not the right connections. Those things are useful and sometimes even necessary, but without the understanding to use them well, each of them can also make things worse rather than better, as any number of lottery winners and highly paid athletes who ended up broke can attest. The wealthy person's most valuable financial asset is not their portfolio or their properties or their business. It's the financial intelligence that allowed them to build and sustain those things, and that would allow them to rebuild from scratch if everything were somehow taken away, which is a level of security that no amount of accumulated wealth without corresponding understanding can actually provide. Let me close with something I think deserves to be said directly about this book's place in the landscape of financial education. Rich Dad, Poor Dad is not a comprehensive financial guide. It has real factual imprecisions, significant gaps in specific guidance, and a motivational tone that occasionally oversimplifies the genuine difficulty and risk of the strategies it describes. Anyone who reads it as a complete guide and acts on it without doing considerably more research and ideally consulting knowledgeable advisors is taking an unnecessary risk. But it is one of the most effective books ever written at doing the one thing that needs to happen before any other financial change is possible: convincing people that the conventional financial narrative they grew up with is not the whole story, that the way most people relate to money is not the only way, and that financial freedom is not just for people who happen to be born wealthy or lucky. The readers who get the most from this book are the ones who treat it as the beginning of their financial education, not the entirety of it, and who allow its perspective-shifting core ideas to motivate them to go considerably deeper into the specific knowledge that will allow those ideas to actually translate into different decisions and different outcomes. That's the honest, complete, balanced treatment of what this book contains and what it's worth. Start with the conceptual framework, be skeptical of the specific claims, build the financial literacy to evaluate specific opportunities for yourself, and don't confuse being inspired by a philosophy with having the knowledge to implement it safely and effectively. Your financial education started the day you were born, whether intentionally or not. The question is whether you're going to be deliberate about it from here forward, or continue letting it happen by default, which is what the script most people were given essentially ensures. Thanks for watching all the way through. The next page of your financial education is whatever you choose to read next.